Good afternoon, everybody. Welcome, and thank you for joining us for this last Monetary Policy Committee meeting of 2012. Since the previous meeting of the Monetary Policy Committee, the domestic growth outlook has deteriorated, while the upside risks to inflation have increased. Widespread labour market instability and work stoppages have reduced output and export volumes, with the potential for employment losses. Risks to the inflation outlook have been increased by a further depreciation of the rand exchange rate, partly in response to these developments, as well as by a possible higher trend in wage settlements and the impact of the reweighting and rebasing of the CPI basket by Stats South Africa. At the same time, the global environment remains challenging, with slowing growth in a number of regions, declining global industrial output, the worsening Japanese outlook, continued uncertainty regarding US fiscal policy, and a resurfacing of concerns relating to the resolution of the crisis in the Eurozone, which is now in recession. The year-on-year inflation rate as measured by the Consumer Price Index for all urban areas at 5.6% in October 2012 and up from 5.5% in September was 0.2 percentage points above the market consensus. The categories of food and non-alcoholic beverages, housing and utilities, and transport together accounted for 3.5 percentage points of the inflation outcome. The upside surprise was mainly attributable to food prices, which increased by 2.8% month-on-month and 6.7% on a year-on-year basis. Core inflation, as measured by the exclusion of food, petrol and electricity from CPI, measured 4.7%, unchanged from September. Administered prices excluding petrol increased at a year-on-year rate of 7.5%. Year-on-year producer price inflation moderated further to 4.2% in September, having measured 5.1% in August. This favourable trend was driven mainly by lower rates of increase in the prices of mining products. A marked acceleration was seen in the food-related categories, with agricultural prices increasing at a year-on-year rate of 5.2% in September, compared with 4.3% in August, and a recent low of 1.7% in May. Manufactured food prices increased by 9% and 10.1% in August and September, respectively. The inflation forecast of the bank reflects a deterioration in the inflation outlook for 2013 compared with the previous forecast. Inflation is now expected to average 5.6% in the final quarter of 2012 and 5.6% for the year. It is expected to average 5.5% in 2013 and 5% in 2014, with a peak of 5.7% expected in the first quarter of 2013. This near-term deterioration is mainly due to higher expected food price inflation, as well as the recent depreciation of the rand. Core inflation remains contained, indicating the absence of significant demand pressures. This measure is expected to peak at 5% in the first quarter of 2013 and to average 4.8% and 4.5% in 2013 and 14, respectively. These forecasts do not incorporate the new CPI weights and rebasing recently announced by Stats South Africa, as the finer details of these revisions, including the introduction of new products and the method of linking the old and the new baskets, have not yet been finalized. Preliminary evidence suggests that a slight upward bias to the bank's central projection for headline CPI inflation could occur in 2013. On the assumption that the rate of increase of price changes for most goods and services, apart from food and electricity, is more or less unchanged, the combined average upward bias would be relatively small, in the order of around 0.2 percentage points. The new weights and the rebased index will be incorporated formally into the bank's forecast in 2013 after the revisions have been finalized by Stats South Africa. Inflation forecasts of financial analysts surveyed by Reuters have also been revised upwards. Financial analysts now expect inflation to average 5.5% in 2013, compared with 5.3% in the previous survey. The expectation for 2014 remains unchanged at 5.4%. It is unclear if these forecasts already take account of the changes to the CPI weights. The break-even inflation rates have also exhibited a moderate upward trend since the previous MPC meeting. The global economic outlook has deteriorated somewhat with a return to recession in the Eurozone. The prospects for the region remain bleak amidst pro-cyclical fiscal austerity, continued household and banking sector deleveraging in a tighter regulatory environment, and renewed concerns relating to the unresolved sovereign debt crisis. The deepening recession has served to heighten the solvency risk of the peripheral countries. The recently announced outright monetary transactions, or OMT, the program by the ECB, remains yet to be activated. The Japanese economy contracted in the third quarter, and leading indicators point to a possible recession. Although the UK economy experienced positive growth in the third quarter, the outlook is negative as the favourable impact from the Olympic Games dissipates. The prognosis for the US economy remains highly dependent on progress in resolving the so-called fiscal cliff. The related uncertainty has already adversely affected investment decisions, and while some last-minute political compromise is likely, the ultimate extent of the fiscal contraction and its impact on growth is still unclear. Failure to resolve the issue could result in a recession and derail the nascent recovery in the housing market in the US. Prospects for emerging markets, while still positive, have also deteriorated somewhat during the past months, contributing to the downside risk to the global recovery. Trend growth rates in Asia are declining, and both China and India are expected to experience weaker growth rates, with possible implications for commodity prices. For some time, the exchange rate of the rand has been determined primarily by external developments, particularly changing global risk perceptions. More recently, domestic factors appear to have become dominant determinants of the exchange rate. These include the increased risk posed to the economic outlook by the labour market developments in the mining and agricultural sectors in particular, the widening deficit on the current account of the balance of payments, which is likely to have been exacerbated by the stoppages, and the ratings downgrade by 2 rating agencies, while also retaining a negative outlook. Since the previous meeting of the MPC, the rand has depreciated by about 6.7% against the US dollar, by 5.8% against both the euro and on a trade-weighted basis. Inflows into the domestic market associated with South Africa's inclusion in the World Government Bond Index of Citibank, the WGBI, probably helped to moderate the degree of depreciation over this period. Since the beginning of the year, net purchases of South African bonds by non-residents have totaled 85.2 billion rand. By contrast, non-residents have been net sellers of South African equities since the beginning of the year to the value of 6.8 billion rand. The rand is expected to remain sensitive to both unfolding domestic economic and political developments, in addition to global risk perceptions. The extent to which the weaker rand feeds into inflation will be dependent on the trading range of the rand going forward and the duration of these moves. Most analysts do not expect further weakening of the rand from current levels, and a number of them expect some recovery. However, the rand is expected to remain volatile and subject to overshooting, and its depreciation poses an increased upside risk to the inflation outlook. The domestic economic growth outlook has deteriorated recently, largely as a result of the continued global slowdown and aggravated by domestic events. Mining output has declined significantly as a result of work stoppages, and there are likely to be longer-term implications for output, exports, and employment as the mines adjust to higher labour costs. Labour unrest in parts of the agricultural sector is also expected to adversely affect output and prices. Recent high-frequency data indicate that third-quarter growth was well below the 3.2% recorded in the second quarter. Mining output contracted at a quarter-to-quarter rate of 3.2% in the third quarter, and further contractions are expected in the fourth quarter. The physical volume of manufacturing production was adversely affected by the road freight transport sector strike in September, when a contraction of 2.3% was recorded on a month-to-month basis. For the quarter as a whole, manufacturing output increased by 0.3%. The outlook for the sector remains negative, with the Kagiso PMI declining to a level of 47.1 in October, reflecting an expectation of contraction in the coming months. The bank's forecast of GDP growth has been revised downwards from 2.6% to 2.5% in 2012. Growth in 2013 is now expected to average 2.9%, compared with 3.4% previously, while the growth forecast for 2014 has been revised down from 3.8% to 3.6%. Moreover, the risks to this forecast remain on the downside. The RMB BER Business Confidence Index declined marginally in the fourth quarter and remains below the 50 index level. Consumption expenditure by households appears to have lost some momentum recently, following the 2.9% annualized growth rate in the second quarter. Consumer confidence in the third quarter, as measured by the FNBBR Consumer Confidence Index, improved marginally, but was still at low levels that were not consistent with robust consumer spending. Nevertheless, growth in retail trade sales, which account for about half of household consumption expenditure, has been relatively resilient, having grown at a quarter-to-quarter rate of 1.9% in the third quarter. However, passenger vehicle sales and expenditure on services were subdued. There is still little evidence of demand pressures on inflation. The resilience of consumer demand has been attributed to a number of factors, including low interest rates, relatively low inflation, real income growth, high growth rates in unsecured lending, and until recently a relatively strong exchange rate. Some of these factors may be a constraint on expenditure going forward, especially when combined with higher administered price increases which constrain discretionary spending. The MPC is concerned about the recent trend in wage settlements and the potential negative impact on the economy, particularly on growth and investment. These developments could also result in lower growth in employment creation or an absolute decline in employment. Although the reported headline increases granted in some of the settlements are higher than the actual average increases, there is no doubt that the increases granted are well above inflation. This has the potential to increase aggregate demand and prices, with a risk of a possible wage price spiral, which could negate the real benefits of these wage increases to workers. However, the impact will be moderated to some extent by the inevitable job losses that are likely to accompany such increases in the context of a slowing economy. The cost push effect of these wage increases will therefore depend on the actual increase in the total wage bill, as well as in unit labour cost developments. The most recent wage data, which do not yet incorporate these latest trends, show that in the second quarter of 2012, growth in unit labour costs was 6.1%, while Andrew Levy Employment Publications reported average wage settlement rates in collective bargaining agreements of 7.4% for the first 9 months of 2012. Wage settlements at these levels were not assessed to pose a major risk to inflation, and these trends will be closely monitored as the collective bargaining landscape has become more fractious. It is also too early to assess the impact of recent developments on employment. According to the quarterly labour force survey, total employment increased by about 200,000 in the third quarter of 2012. But the increased number of unemployed workers resulted in the unemployment rate increasing to 25.5% in September. It is expected, however, that the positive employment trend in the non-gold mining sector observed during the past year is likely to have reversed or slowed down, while the negative employment trends in manufacturing and gold mining are likely to persist. The net effect of higher wages and lower employment on aggregate expenditure is therefore still unclear at this stage. Credit extension to the private sector moderated on a quarter-to-quarter basis in the third quarter of 2012, when an annualized increase of 5.4% was recorded. 12-month growth in total loans and advances to the private sector was 8.8% in September. However, mortgage loan growth remained subdued. When this category is excluded, loans increased at a significant 12-month rate of 16.6%. The main impetus has come from the persistently strong growth in unsecured lending to households, and this has been related to real income growth, particularly in the public sector. Growth in unsecured lending to households remains in excess of 30%, but there are some tentative signs that this growth may be moderating. Although to date this has not represented a systemic risk, as it is still a small part of total loans and advances, this has been carefully monitored by the bank. Unsecured lending has probably helped to underpin household consumption expenditure. The fiscal stance, as reflected in the medium-term budget policy statement, remains supportive of the economy through its contra-cyclical stance. Although the goal of fiscal consolidation is being maintained, the timing has been pushed out further, as lower expected growth is likely to result in lower revenues. Growth in expenditure is projected to remain the same as that set out in the February budget, and no large boost to aggregate demand is expected that could impact on the inflation outlook. Food prices remain a significant risk to the inflation outlook. Global food prices, while still high, have declined from recent peaks. The impact of this shock is still to fully filter through to domestic prices. Although there is usually a lag between the impact of global food price developments on domestic prices, the impact appears to have been felt more quickly than is generally the case. The recent depreciation is also expected to exacerbate the upside risk to food prices. Futures prices, however, indicate that maize prices may be moderating following a better than expected domestic harvest. International oil prices have remained relatively unchanged since the previous meeting of the MPC, although in the past few days have increased following the ongoing hostilities in the Middle East. Domestic petrol prices declined in November despite the depreciation of the rand, and should the exchange rate and international product prices remain at current levels, a further moderate decline can be expected in December. However, international prices remain highly dependent on the global growth outlook, as well as on political developments in the Middle East. Since the last MPC meeting, the domestic landscape has seen a marked change. While the global crisis remains unresolved, South Africa has seen significant developments that have impacted on the economic outlook and on confidence. These domestic developments, if not addressed in a comprehensive and constructive manner, have the potential to derail the progress made to date, whereby South Africa has been able to withstand the worst contagion effects of the ongoing global crisis. While recognizing that there are real issues that underlie the recent wave of wildcat strikes, the Bank is concerned about the conduct of some of the parties involved in the recent labour market instability, and in particular the unacceptable levels of violence that have accompanied the strikes. It is critical that both employers and employees take constructive steps to address the fraught relations that appear to be prevalent in a number of areas. Employers need to better appreciate the contribution to stability that an informed, experienced, skilled and organized workforce can make, and also need to be better informed about and sensitive to the conditions and circumstances of their employees. An important element of this is to take measures that enable employees to be better informed about the financial situation, strategy and future plans of the companies and sectors that they work in. At the same time, employees need to ensure an end to the use of violence in labour relations. In their quest for fair and decent employment conditions, employees need to recognize the potential negative effects of unsustainable cost structures on employment levels and competitiveness in the absence of improved productivity. In the prevailing conditions, there is the danger of a wage price spiral, and, inevitably, it will be the workers who bear the brunt of the fallout. The costs are not only the direct costs in terms of lost production, but also the possible increased costs of finance. In the context of a very weak global economy, where South Africa should strive to be a destination of choice and thereby grow the economy and achieve the pursued developmental and employment goals, the ability to attract investment and improve the country's ratings must be a clear objective. While many of the strikes appear to have been resolved, long-term resolution of the underlying causes requires ongoing concerted action on the part of all parties involved. We need cohesion and certainty of policy, as well as unity of purpose to build an inclusive, longer-term vision. The National Development Plan is a broad unifying framework that has been adopted by both Cabinet and Parliament and could form the basis to take the country forward, enabling South Africa to play an effective role in the continent as a favoured trading and investment partner. The MPC assesses the balance of risks to the inflation outlook to be on the upside, given the continued pressures on food prices, uncertainty of the exchange rate movements, and the reweighting and rebasing of the CPI. Furthermore, the possible impact of higher wage increases could exert further upward pressure on inflation, notwithstanding the concerns that recent developments in the labour market could impact negatively on employment. The MPC considers that the demand pressures on inflation at this stage remain relatively benign, as evidenced in the contained trend of underlying inflation. There are also signs of moderation of consumption expenditure against the backdrop of a weak supply side of the economy. The negative output gap is expected to persist for some time, and the balance of risks to the growth outlook remains on the downside. In the light of these factors, the MPC is of the view that the current accommodative stance remains appropriate and has therefore decided to keep the repo rate unchanged at 5% per annum. As always, the MPC will monitor developments closely and will not hesitate to act in a manner consistent with its mandate. Thank you. You'll also find at the end of your statement the dates for next year. I think you all have that. So that would be something for you to put in your diaries. And we'll come back to that at the end of the press conference. I'm now happy to open for questions, and as always, my colleagues will remain ready to answer. Yes, sir.
Governor Ed Stoddard with Reuters. Governor, what in your view, looking at, you named 2 or 3 factors that you see as being significant risks to inflation on the upside. If you had to rate them, which one would be the most concerning to you?
Okay.
Thanks.
Miriam?
Thank you, Governor. I noticed that in your new inflation forecast, you have a peak of 5.7% in the first quarter of next year. Given that the central bank normally takes the average over the quarter, is there any risk at all that inflation could pierce the upper end of the target range?
Good question. Yes, sir.
You say in the statement today, as you have in the past, that unsecured lending is unlikely to pose a systemic risk to the financial sector. But are you worried on the consumer side that it could dent consumer spending and output?
Sorry, I didn't get your name.
Sorry, I didn't say it. Pat McGrory from the Wall Street Journal and Dow Jones.
That's Pat. Colleagues, please feel free to add. I think in terms of inflation, there obviously are a number of questions, and I wouldn't want to say this is more important than that, but clearly it is food prices. We have that lag. We've seen what's happening, and that is obviously critical because it certainly impacts and is of concern. The question would be the depreciation of the currency. That obviously also has an impact. And as we've said in the statements, and repeat, it depends how long it goes, to what band does it trade in. It seems to have moved to the second part of 850 to 90 at the moment, and for how long that stays and the impact in that regard. And obviously the third question will be if there is a question of wage increases that become, in the total wage bill, become an impact. So all of those factors would be part of what we would consider critical. In relation to the forecast, is there a threat to piercing? Yes. The question would be, it's not in the forecast, but there are a number of uncertainties, and as we've pointed out, that in regard to the outcome and the forecast, the consensus forecast, there was an underestimate in that sense by 0.2%. So the question for me would be, is there a risk? Yeah, there's a lot of unknowns at the moment. And we don't see it in the forecast, but we cannot rule it out. In terms of unsecured lending and consumer spending impact, you mustn't forget that unsecured lending takes place at a whole lot of levels. It isn't just what occurs through the banking sector. And therefore, South Africa's ability to sustain, or the consumer's ability to sustain itself, depending on what levels of debt they've gone into, in areas. We obviously look at the unsecured lending within the banking sector, but there's a whole range of unsecured lending that takes place outside, and that's part of what the National Credit Regulator looks at and so on. So there is obviously concern about the possible rising trend around the debt obligations of people and what unsecured lending is used for. So within that, can it impact? Yes, if they have multiple obligations in terms of what consumers want to spend on. But in terms of the overall, what we're seeing, debt to disposable income has dropped quite, it's got a little uptick at the moment, but it has dropped quite significantly. And also the cost of servicing debt is significantly lower. But we would urge consumers to be cautious about their indebtedness. I don't know, colleagues, if you'd like to add anything. Yolanda, do you have anyone there? No one? Franz?
Governor Franz Wild from Bloomberg. A couple of the usual questions. Was it
unanimous?
Was it unanimous? And did you discuss a cut?
We didn't discuss either a cut or a raise, okay? And it was unanimous. But again, I want to emphasize that it's not something that we go there and just say, okay, are we all of a mind? We try to really unpack what is driving issues, to look at them beyond what appears to be there. We spend a lot of time discussing, and I think very constructively. So it is, and I think the spirit of the members of the MPC, as well as the broader team that supports the discussions and the data, is one in which we really are not complacent. We try to examine in the detail what is driving issues, how can it be interpreted, the pros and cons of it continuing for any period of time. So I think a vigorous and robust discussion, but not one in which we had a difference of view or that we discussed either raising or lowering. Okay, you want to follow up?
What factor did the recent rand weakness play in, your considerations to not cut?
I told you we didn't discuss whether we should cut or the reasons for it, which means that we didn't discuss it in relation to cutting. But obviously, what we've looked at is that, and you can see it reflected in the statement, it's referred to a considerable number of times, that the depreciation of the currency is an important factor. It does impact on inflation, and it depends on how long the depreciation lasts and in what band. So was it subject to discussing the impact and implications of a weaker exchange rate? Absolutely. But not in relation to whether we should cut or not, its implications. That's what I'm trying to say, is we look at something, let's take the question that you're raising of the exchange rate and a depreciation, is we try to examine all its consequences, right? So we would look at it in and of itself. If we were discussing a possibility of a cut, we would then look at it in relation to that. But as I said, we did not look at it in terms of either raising or cutting at this point in time. Let me see if yes, sir. I'll come back to you now, ma'am.
Tsepamwa, SABC. Your statement seemed to have paid attention to the current industrial or legal actions in the mining sector. Perhaps, Governor, in a nutshell, what is the message that you're really trying to get across to South Africans? And a second question, it might not necessarily be related, but is the talk of counterfeit notes. How serious is this issue? Have you looked at it? Should we be worried about it?
Let me deal with the first one first, which was what message are we trying to get across? We're saying that we need to have a South Africa that has the confidence and the direction that addresses the uncertainty that has been created given the recent events. And I think that I've spelt it out quite clearly in the statement. I wouldn't want to add to that. But that's what we're saying, is everybody has a role to play. Make sure that we get a coherence in what we do, a coordination in what we do, recognize the weaknesses that exist in relationships, address them. Yeah, so to me the question is, we've spelt it out there. I don't think I could be clearer than that, and to say we need to ensure that South Africa is a destination of choice. And these are the steps that need to be taken to address that. With regards to the notes, it's fairly normal that everyone will find that, and you'll see that around the world, that when new notes are introduced, there are always endeavors to see whether they can be counterfeited or copied. That's why the campaign has focused, and we would reiterate that to everybody. The way you protect the note is by every South African knowing the security features of the note, that you look and see what are the features, you're familiar with looking for the watermark, the feel of the note, the question of the enhanced security features, which are very difficult to copy, and that we don't allow people who would like to take advantage of the introduction of a new note. So we know of 3 instances that, and I'm sure that Tlengani has dealt with that before with you, but we know of 3 instances where there have been attempts to pass off notes. I don't think that that is a significant impact. It's not unexpected. If you look at all countries, when they introduce new notes, there's always that endeavor at that point in time, which is why, as I said, we spent a lot of time and a lot of effort communicating about the new note so that all of us, every single one of us, protect the integrity of our country, of our currency, because we know the security features. So is it something that will be important? Yes, all of us need to ensure that we protect the value of the integrity of our currency. And bear in mind that this is a currency that's used very widely in the region. Other questions? Miriam?
Thank you. This is in a way a follow-on from a previous question, but I wanted to ask, when you speak about the need for the ability to attract investment and improve South Africa's ratings as a clear objective, and what particular policies in terms of the economy do you think should be taken in order for this to happen?
For me, it's not policies that I can direct more broadly into what is the province of other spheres of responsibility, because obviously government has a role, but it is government is clear, business is clearly labor must also play a role. But part of the question around policy that we have is that you need to have as much certainty around your policy, you need to have confidence. So in terms of the macroeconomic framework, the questions of your fiscal monetary coordination, the ability to draw from both would be for both to play the complementary roles that they need. The certainty that this is what we are doing. So if you ask the questions that are raised, what would happen to your fiscal deficit, what happens if we get to a zero bound or zero interest rates, what is your policy? These are the kind of things that we are responsible for in our interactions, certainly with the Treasury. Beyond that, I think it is about many issues that affect South Africa, whether it's education, healthcare, trade policy, all of those areas. But it's not for us to comment on those responsibilities. On ours, a certainty of the coordination, interaction, and complementarity of fiscal and monetary policy.
Can I just follow up on that? As far as coherence goes, there's a lot of friction at the moment between business and labor unions. And I just wondered, I mean, since you dwell on it quite a lot in the statement, what are the chances, do you think, of this friction being resolved?
I think that's given, anything can be resolved if you have the will. So that's why we've addressed specifically, in a very, very brief manner, the question of the importance of addressing the relationships between employer and employee and your workforce as a whole. And we've just put a couple of things down that we think are important to address. I certainly think that if in the interest of a growing economy, addressing the threats of unemployment, ensuring that we do have the kind of growth that we need, and the stability in the macroeconomic environment that we need, it must be resolved between business and labor. And I think it can be. But it's up to both parties there. You want to add anything? Other questions, comments? France.
Governor, you say that inflation is expected to peak at 5.7%. Would you consider that to be within what you would call the upper end of the target margin, or how would you define?
Well, it's certainly below 6%, isn't it? So it's got to be within the upper end.
Well, how would you define the upper end? What's your?
It's a good target band between 3 and 6%. And as you've seen in the past, I'm not saying it is simply repeatable because the conditions are different, but if you look at where we were, slightly outside the target at the upper end, our question was how long are we out, what is causing it, how quickly would be the trajectory to get back in. And those are the factors you would take into account in terms of your decision making should you breach the upper end. 5.7% is at the higher end of the target, but within the target. So, you know, it's what the forecasts say. Is that going to be the turnout? We wait and see. But that is what all the forecasts indicate at this point in time. So if you're asking me, would I be happy with 5.7%, I'd certainly be happy with 5.7% if it was the limit and you didn't go beyond 6. So would I be happy it's in the band, right? Are we complacent about saying we're at the higher end? No, but it does depend on what the conditions are. You can't get, you will not get, I think inflation expectations are pretty well anchored, but you're not going to get them at the lower end of the 3 to 6% until you have inflation at the lower end, because expectations will follow experience. So that if your inflation, as it is now, is between 5 and 6% and has basically been there for some time, and as we said, the inflation for this year is expected to be at 5.6, you're not going to get expectations at 4 until you have an experience of low inflation. But is that the trajectory we would like to go in? Yes. Other questions, comments? Colleagues, anything you'd like to say or add? You're all fine. Then thank you all very much. Thank you for coming through. I hope you have a very good Christmas break. I think next year is going to be even busier. So we look forward to seeing you in January and at the MPC meetings for next year. And we wish you all the best and thank you for your cooperation and interaction with us over this period. Much appreciated.